Okay, welcome everybody. Thank you for coming to this presentation on what is a strange term, straddle busting. And I sent a link out to the slides. If you haven't seen that link, you can go to edgerater.com/webinars/SP June 2023. And you will find a page there which has a link to the slides. And there's also a link on that page to a follow-up webinar, which will be next Saturday at 9 Pacific. And that will be on EdgeRater core templates. So for anybody who hasn't used the program in a while or is new to the software, that will be a good webinar to come to. So also for those who haven't met me before, I used to work at Microsoft. I left there in 2007. And developed a program to help traders be more profitable. And today that program is known as EdgeRater Pro 2020. And that has been developed over all that time period. And new templates have been released in the program so that now we end up with more than 120 individual templates. In addition to the original capabilities for backtesting and charting. And the new thing that I've been working on this year has been the addition of unique options data points. And those data points, some of those we're going to be talking about today, but they can really give you a great edge in your trading. This template is all about straddle busting. This is an EdgeRater only term. You won't have heard that before, but once I explain what it is, you'll immediately see how it makes sense. And straddles are it's an options strategy. So I know a lot of people here trade options. They know what straddles are, but we also have people who don't trade options yet. So I just wanted to go through some of the basics to get everybody on the same page. So an at the money straddle, it's a spread. An option spread consists of a call and a put struck at exactly the same expiration and the same strike price, but where the strike price is closest to the current price of the underlying asset. And you can be either long or short the straddle. If you are long the straddle, you will profit on larger than expected moves in the price of the underlying. And if you're short the straddle, you'll profit if the price stays within a certain range. So on a graph, profit and loss graph, the short straddle looks like this. In this case, we're looking at a strike price of 100. So straddle is struck at $100. You have a limited gain. If you're short the straddle, you're limited to the gain of in this example, the straddle costs $10. But with options, you multiply by 100 to get the actual dollar figure. So that is $1,000 limited gain. And you'll receive that gain here if the underlying asset is $100 at the expiration of those strikes. And you will make money from anywhere from $90 all the way through to $110. So that's basically the strike price plus or minus the premium that you paid for the straddle. You also have an unlimited loss. So if the underlying asset has some extraordinary event, whatever it might be, some short squeeze happens and price just rockets out of control, then with a short straddle, you have an unlimited loss possibility. So that's kind of always the worrying thing with short straddles. But the positive thing about short straddles is if price stays within a certain range, you make money. And if price didn't change and time just went by, you would end up just making what is called theta, time decay of the option, and you would be quite happy. On the long side, if you were to buy the straddle, you flip the chart upside down, and now you have a limited loss. So if the stock price ended up at 100 by expiration, in this case, you would lose $1,000. But that's a defined limit. When you put that straddle on, you knew that risk, and you were prepared to take that loss. That's the maximum loss you can ever experience in the straddle if you're long. But you do have this enticing feature of an unlimited gain. So again, in the example of a short squeeze, the stock goes out of control on the long side. On the upside, you can have unlimited gain in the straddle. So the participants in the market for options, you can roughly categorize them into three different types. So you have the dealers who buy and sell options to satisfy demand and supply, but then the dealers hedge their exposure by buying and selling offsetting stock positions. So you can think of the dealers, they're providing liquidity into the market. Then you have professional traders, and professional traders are mainly sellers of options, and they try to take advantage of the only certainty in the market, which is time decay. And when you sell an option, you can profit if the price remains unchanged or stays within a range. And then you have retail traders, which I'm guessing most of the folks on this webinar are retail traders. And retail traders are mainly buyers of options, although there are many strategies where you do sell options. So you know, some retail traders are also sellers of options. But the advantage of selling an option, as I said before, is it carries limited risk. And the most you can lose is the premium you paid for the option. However, when you buy an option, you need price to move more than the premium you paid. So putting that into both sides, the short and the long side, you can see that there is a large loss zone on the short side if price goes outside of expectations, past the break-even points. And on the long side, you can see that going past those points will actually put you into profit. So it's a struggle between the shorts and the longs. You're trying to come up with a point where you think price is going to be. And if the longs are right, price is going to break through those break-even points and they're going to make money. And if the shorts are right, price is going to be contained and the shorts are going to make money. So those break-even points are very important. And that would be called the expected move. It's the price level that traders have agreed via the mechanics of the market that represent the one standard deviation likely range of movement of price. The terminology that EdgeRater has come up with when that price gets exceeded is called a busted straddle. So here's the chart again on the long side. The break-even points are the dotted lines here. Expectations, the movement of the stock is between these two lines. That's the expected move. Anything beyond there, the straddle has been busted. If the straddle is busted, the longs are making money, the retail traders are making money. If price stays in the expected range, the professionals are making money. And so that's the basic terminology and the idea behind straddle busting. So another key point in this presentation is the idea of a next expiration. With options trading, you have many different expirations of the options. Weekly options expire every Friday. Monthly options expire the third Friday of every month. But the closest expiration to present day is called the next expiration. So with weekly options, the next expiration is never more than 7 days away, and mostly on a Friday. And for all other options, not CBOE weekly options, expirations on the third Friday of the month. Now, SPY kind of is an exception to this. SPY now has more options than just weekly options. You also have Wednesday options and Wednesday expirations and Monday expirations, I believe. So SPY has a lot more expirations, but a lot of the other stocks, the common, highly liquid stocks are weekly expirations that expire every Friday. And the variable or the terminology that determines when expiration is called the days to expiration. So DTE is a shorthand for that. And I'll mention DTE quite a lot in this presentation. So in terms of EdgeRater, as I mentioned earlier, has been around since 2007. But one of the things that we've been working on in the last year is options data and improving our processing and analysis of options data to provide that information into the EdgeRater program. It's been an interesting path to getting this data, and I should also mention that I've been happy to work with, as some of you will know, Paul Duncan from Gamma Edge. So we've done a lot of work together, and it's kind of allowed me to focus on some of this options data in the program. We'll have more information on that, I'm sure, coming up in the coming months. But so EdgeRater, we subscribe to end-of-day options data, and the data points we subscribe to are the bid and ask price, the underlying price, delta, gamma, implied volatility, open interest, and volume for every optionable stock, every expiration, and every strike. End-of-day data. That's a lot of information. We download that every day. We store it on our server. It's over 1 terabyte of data. And every night after that data comes into our server, we process that, and we produce some key data points that are unique to EdgeRater. And those data points get downloaded to you in your EdgeRater program when you do the daily update. And then your EdgeRater program will have access to that data for charting and backtesting, scanning, and templates, which is where the template straddle busting comes into play. And in addition to that, there's also a feature where you can draw a line on a chart, and I'll show this later, between any two data points, and it will show you the profit and loss percentage of every single option between those two data points. So that's the focus essentially of EdgeRater over the last year. So it gives every EdgeRater user unique insight into the stock price behavior in the context of option pricing, where a lot of traders are only looking at stock price. So that's a really great edge for your trading. And Paul has just given, if you look at the chat, Paul is giving some information about expirations on the SPY, the Qs, and IWM. So SPY is Monday through Friday, Qs are Monday through Friday, IWM is Monday, Wednesday, and Friday. So yeah, so those ETFs have more expirations than the other stocks. So they're the highly traded, most liquid options that there are, SPY in particular, and so expirations pretty much every day in SPY and the Qs. So what are the implications of busting a straddle? So even if you don't trade options, and I know some people don't trade options, but even if you don't trade options, pay attention to when straddles are busted, because these are indications of unexpected moves, unexpected in either the up direction or the down direction in the underlying stock. So that they can be a sign of new behavior emerging, and you want to have these stocks on your radar. In EdgeRater, there's a new indicator. It's under the options data if you look in the chart scripts, and it's called the ATMS next _% change. This is a bit of a mouthful, but it stands for at the money straddle next expiration %1 day change. And that indicator is available for every stock in the new liquid options symbol list. So I'll just give you a quick idea of what the liquid options symbol list is. It's a new list, contains the underlying symbols of the most liquid next expiration options. And it's been collated by analyzing all the open interest in the next two expirations of most penny increment options. And it represents the most tradable underlyings when trading next expiration options. So in general, this is also an excellent list for stock trading because there's high liquidity in the underlyings too. And currently this list consists of 164 symbols, but it will be updated going forward as we monitor the open interest in the next 2 expirations. And so this is a dynamic list that just represents the options and the stocks that have high liquidity. And so you're not gonna, with high liquidity, you have a better chance as a trader because you're not fighting with the bid and the ask spread. It's easy to place a trade at the mid price. So put that together on a chart, and here's an example of the straddle busting template, the chart that's associated with that, with Qualcomm. So what we have is the ATMS next underscore percent change. So that's the basically the 1 day percent change in the at the money straddle. If there's a green bar here, it means that the straddle was busted. If there's a red bar, the straddle was not busted, it lost money. Professional traders made money in the red bars. Retail, you can think of it like that. Retail traders made money on the green bars. And so, that's important if you are looking to trade options on the long side or the short side. You need to have, it would be nice to have an idea of whether that would be, in general, beneficial to you. You can obviously take other factors into account, but that as like number one thing to think about is, do these stocks generally favor the buyers or the sellers in their options? As a concrete example in here, you've got this red bar pointed to here. This is a 57% loss in the straddle, whereas the green bar at the end here was a 310% gain in the straddle. And to be clear of what we're looking at, these are 1 day percent changes in the at the money straddles. So those straddles, every single day, it will be a new straddle because price will have moved. So the at the moneyness of the straddle will have changed. For instance, in this run up here, you've gone from at the money being 125 on this bar here to this bar here. The at the money is 140. So every day, this recalculates the straddle, figures out what the new straddle is, and then gives you the new percent change for that straddle. Of course, it could be the exact same straddle, but I'm just saying the simulation that is occurring here is basically selling the straddle of the prior day, buying a new straddle for current day, and so on and so forth. So the question, Ross, high liquidity is the liquidity test for doing these liquid options was really just a test based on the 2 front months expirations, looking at the open interest, and then also taking that from a list of mostly penny increment options. And also then adding back in a few that didn't pick up, which were clearly high liquidity and worth putting in the list. So the other thing to mention is if there are stocks that you trade frequently, or stocks with options that you trade frequently and you don't find them in the list, send me a note. I can easily put them in the list. Another question. Okay, yeah, that's a good question. So Jay, this is the at the money straddle. All the pricing data that we get in EdgeRater is end of day. And a bit more precisely than that, it's always 3:45. It's always 15 minutes prior to the close of the market. So yeah, so that's the pricing we're getting. The reason that we are not getting end of day pricing is as soon as you get to the end of the day, all of the options spreads just widen out. It just doesn't give you good information. So we're trying to get tradable information while the market is still open. The data we get generally is 3:45 p.m. when we're relating this data to the price of the underlying, we obviously cannot use the close price of the underlying stock because the close price of the stock is at 4 p.m. So we always go and use the underlying price from our options database, which is the price of the stock associated at the same time that we took that snapshot of data. Okay, I hope that makes sense. Okay. Oh, thanks, Dave. Glad to see you here. Good to see you. It's Dave McMullen online. Thank you. Okay, so then the next thing is how often do straddles get busted? So if you look at option models, Black-Scholes model, the expected move boundary of one standard deviation imply that boundary should stay intact 68% of the time. So the straddle should get busted 32% of the time as a general rule. When I researched this information to create this slide, this was on May 27th, so not quite a month ago. The number of trading days so far in the year were 101. So it made it very easy to calculate a percentage. And it turns out that the straddle most busted, not in terms of how far busted it was, but in terms of number of days that the straddle was busted, was Google. And the least busted was Coca-Cola. So that implies if a straddle is busted more than 32% of the time, it implies that the straddle is not priced correctly. It's underpriced. It's an advantage for the buyer of the straddle. It's an advantage for retail traders. If the straddle is stays within the boundary and the professional traders who are selling the straddles are making money, then the straddle is overpriced. If it stays within that boundary too much, more than 62% of the time or 68% of the time, then it means that the straddle is overpriced and the professional traders are making money. As a retail trader, you probably don't want to be buying those straddles, or you probably don't even want to be buying those options. So it's a good idea to have a heads up of what straddles tend to get busted, and that changes over time, of course. So you put that together on a chart. We're looking at Google, and these are some of the indicators that we've come up with. These are some of the indicators that we've come up with. These are brand new for EdgeRater with this release. This is Google up to May 27th. We're looking in the area here of busted straddles. The blue lines are just heads up, that's earnings. Okay, blue lines are earnings. If you have a green bar, as I said before, the straddle was busted, retail traders made money. If you have a red bar, professionals are making money. But Google has generally been a great stock for retail traders. What we see below here is the implied volatility of the next expiration. Implied volatility is derived from the price of the options. So when implied volatility is high, it means that the price of the options were high, the price of the straddle was high. When you come into earnings, this blue bar here, the implied volatility just goes crazy because earnings, that's a singular event. Some information is going to be released that's not been known publicly before, and that's going to have an effect on price. So implied volatility goes high, option prices go high. Your chance of making money on a straddle might be, we can't say that your chances are less. It just means that there's more expectation of a large move. So the price has to move a lot more than on non-earnings dates in order for you to make money. But you often can make money on those moves. But more importantly, the price of the straddle gives you an idea of what the move could be on earnings, on earnings. Anyway, below that there's these red dots are essentially the price of the straddle as a percent of the price of the underlying. It's done as a percent of the price of the underlying to give you a good reference point, because obviously as price moves up and down, the straddle price will naturally move up and down. You know, if the price of the underlying is $1,000, your straddle price is going to be a lot more just naturally, regardless of implied volatility, than if the underlying price was $100. So given this as a percentage of options price gives you an idea as to whether relatively the straddle is, or the options are overpriced or underpriced. The dots will be coming down, and it's best to explain that with the next line, which is the days to expiration of the next expiration. For normal weekly expirations, that's going to start at 7 days to expiration, this dot here. Then we'll get through the weekend. 7 days will be on a Friday, by the way. Then we'll go through the weekend. We'll come down to Monday, all the way down through till Thursday, when there's 1 day to expiration. And then we jump back up to 7 days to expiration. So that's why this DTE next looks, it's not a uniform, because you've got this weekend in between. So it's not a uniform looking chart. Okay, so that's what it looks like for Google. Advantage to the option buyers. What's it look like for Coca-Cola? Advantage to option sellers. You have a lot more red bars here in the straddle. Regardless of the implied volatility and the price, basically so far this year, Coca-Cola the straddles have been overpriced. And rounding this out to taking the entire list of liquid options or stocks with liquid options, this is 164 stocks listed from the least busted, Coca-Cola, up to the most busted, Google. Also Snow, same level as Google. And so you can see, if you're interested in trading options on the long side, which some people are, take a look at the ones that are busting their straddles frequently. If you're on the short, if you're more of a short side trader, take a look at the ones that aren't busting their straddles, staying within their range. So then the next question was, what would happen if all you did was buy a straddle every day? So on Monday, you buy the next expiration straddle. On Tuesday, you sell that straddle. This is at the end of day, by the way, 3:45, as we talked about. You sell that straddle, you buy the next one. On Wednesday, you sell that straddle, you buy the next one. On Thursday, you sell that, buy the next one, and so on. If you did that this year, from January till May, this is the dollar amount you would have made in all of the stocks. And remember to multiply this by 100 because of the multiplier on options. NVIDIA, you would have made $6,100 so far this year with a very simply doing that. In SPY, you'd have lost $4,500. So these are the stocks that so far this year, straddles have been underpriced, and these are the stocks where straddles have been overpriced. The orange ones have been overpriced. So on the chart, let's expand that out. Let's take SPY. Let's go back, not just this year, but let's put that on a chart with since 2013. Okay, we've got 10 years of data here. So here you can see SPY generally going up left to right. That's easy to say, but we will remember this time in here, which is very volatile. But you can see that the blue line down here, this is your cumulative straddle percent gain. This line is calculated from basically taking the percent gain each day and adding it to the percent gain of the previous day. So if you had one day where the straddle gained 10%, the next day the straddle lost 10%, that would end up being a wash. But you can see that with SPY, you generally end up losing money with periods of, I'm saying if you're long, if you're short, you would end up obviously on the winning side. But if you're long the straddle with SPY, you end up just having that money sucked out of your account. You end up with periods where you get you get a little bit excited, you know, they give you some back and then they take it away again. Okay, SPY, no good for being long the options or the straddles. Remember, a straddle is just a long call and a long put. What about Google? If you take that from 2014 and you just bought the straddle every day, sold it the next day, this is how that looks. Since 2021, it's been great. It's basically a lower left to upper right move. And also in 2021, look here, Google went straight up and then it came straight down. The straddle just continued going up. So you didn't care about what side you were on here. You're just making money on the long side, and you're making money on the, if Google is increasing in price or if Google's selling off, the straddle's making money. And then Coca-Cola, this is your in-between. This has been going up and down. And you can see from 2023, and this is why it's the lowest on the list. In 2023, the straddles have just been fantastic for the sellers, but terrible for the buyers with this move down here. But overall, since 2013, it's been up and down. And then I mentioned this earlier, so I don't really need to go into this again, but implied volatility is a substitute for straddle price. If implied volatility is high, straddle price is high. Implied volatility and straddle price go high on the last bar before, the last tradable bar before earnings. And you can see that in the charts here. So now put all this information together to what we have in EdgeRater, the data and the template. So I want to just let you know this template, next expiration straddle busters template, is in the options analysis category. And this is how it looks, but we'll go into the software and actually take a good look at that in just a second. Just briefly here, you can see what we're trying to show here is on this day, current day, you can have stocks appearing at the top of this list because the straddle has made the most percentage gain, whether the price of the underlying went up or the price of the underlying went down. This is agnostic to price. It's just talking about whether expectations were exceeded or contained. And so with that, the last of my slides, I will get into the demonstration. So I hope everyone can now see the screen on, I'm just changed over my monitor. Yeah, and sorry, I'm just taking a look at the questions here. Okay, so if you have the program and you have, one of the things you need with this program is you need to have access to the premium data. Premium data includes updated templates, includes the EdgeRater premium end of day data, includes the options implied volatility data, and all of the options data and all of the earnings data. So just as a heads up, you do need to have that premium data subscription in order to run this template. So find your liquid options symbol list. That is here. You'll see all the stocks in here, 163 of those. And as you can see, I've got this updated to the 23rd of June, which was Friday. And then you just run that template and it will produce a report like this. Okay, so I'll just explain what we're looking at here. First of all, each row is a separate stock. Okay, the next columns of interest are these columns here. So the first one is the days to expiration. So when you're looking at this on a Friday, the days to expiration is 0. Okay, this is telling you the result from Thursday when the days to expiration was 1. So So on Friday, this is the result of the Thursday's trade, essentially. So DTE on Friday is 0. ST% is the percentage gain in your straddle, and C% is your percentage gain in the underlying. So in this example, and this was Friday, this is real data, JD, that was out of those 163 stocks, that was the highest straddle gain. So the most unexpected move happened in JD. You can see from the report, it was a negative 4.8% move in JD. Look over on the chart, you can see that the again, 1.61 is indicated here. This number should always match up with the number over here. You see where I'm looking at? This green bar, 1.61, should match up with the percent over here. You can also see with JD that it crossed down through a low, which is the 10-day low, and that was an unexpected move down through this low. So immediately, as a stock trader, this is good information for you. An unexpected move in JD down below a low. Fantastic information right there. So, right, what else can we see on here? So that's current day. What about the next 3 columns? That is the prior day. We actually, in the report, are showing the last 10 days of close price gain and straddle gain. So you can sort it by any of those columns, just in the normal way you do with EdgeRater templates. You click on the column header and it will sort. And then the columns G through L are really a summary of those last 10 days. So you can tell in JD, you can see that out of those last 10 days, 5 of them have been the straddlers have been busted, and 5 of them the straddlers have the price has been contained in the expected move. So, and you can see the sum of those percentages. In this case, it's 135%. You can see the average and the median, and then the streak is how many of the past is basically how many of the past n days. What's the number of days that the straddle has been busted most recently? So we can sort by streak, and we can see here Goldman Sachs, that is a 4-day streak. So 4 of the last 4 days, the straddle has been busted. So you can see Goldman Sachs. Okay, basically a pretty rough chart over the last 5-6 days, I would say. However, for straddle buyers, that's been fantastic because you've got 4 of the last 4 days. The straddlers have been making money, 58% on Friday, 55% on Thursday. I'm looking over here, 7% on Wednesday, and on Tuesday, 29%. So that was pretty good for your straddle buyers. Okay, we can see here that also with Goldman Sachs, you are down to a low, this low that was achieved here. So it's one of my new favorite indicators for charts is the highs and lows indicator. If you look in your formula parameters over here, there's a new indicator called highs and lows. And it's basically drawing a line from the 5, 10, 30, and 120 highs and lows. That's periods. So 120 periods, 6 months, essentially. That's the black line. The blue line is your 5-day high and low. Green line is your 10-day. Red line is your 30-day. But it's always offset by 1 day. So when you're looking at the chart, you can see if you're breaking through an important level. If this indicator was to have just updated for the current day, obviously it's not going to show you a breakthrough. It's just going to reset that high or that low to the current price. So it's really important and nice to have that offset by 1 day. So you can see with Goldman Sachs, you're down to basically the 30-day low. That's a really significant price level, 30-day low. Okay, you've just reached that. You've come down with unexpected moves. Super important level. you can't, obviously, you don't know what's going to happen from here, but it's an important level to pay attention to. If you're trading, you can develop some kind of strategy around this. Okay, and I'm sure Paul and the Gamma Edge would be able to tell you more information about, where options people have the highest open interests and the most gamma and all of those great things. But this chart gives you some great information to initiate trades. Okay, so yeah, so we've sorted by streak. Well, let's look at some of the others. So IBM, again, looks very similar to Goldman Sachs, very strangely. Okay. This is broken down through a 10-day level. So that 10-day level, if you take it back through over here, that's definitely that was an interesting peak over there. It's broken down through there with 4 days of unexpected moves. Starbucks. All right, Starbucks has broken down through a 5 days. It's really within a range. I mean, a 5-day breakdown, that happens fairly frequently. Nothing really crazy, but that was pretty unexpected, right? That was 153% gain in the straddle. So expectations broken there. Pay attention to Starbucks, but difficult to place a trade here because you're really just in a range essentially so far. But this template and the associated chart with it are really useful things to take a look at. What I wanted to let me show this. Okay, look down at the red indicator down here. So ATMS next price percent. This is price, as I said before, as a percentage of, so it's price of the straddle as a percentage of the price of the underlying. Now, by default, this is going to show you every single day. But you can see that when there are more days to expiration, the price of the straddle is higher because you're paying for time. A lot of things can happen given time. So the price of the straddle is higher when there are 7 days to expiration, and it generally goes lower as you get closer and closer to expiration. So if you were interested in making a trade and you wondered if the price of the straddle today is low or high compared to previous times when the same number of days to expiration, with the same number of days to expiration, there's a parameter on this indicator where you can choose the days to expiration. So you're going to be comparing apples to apples. So currently there are 7 days to expiration. Okay, it's a Friday. Last data is a Friday. So over here we see there are, if we look at my DTE, we know there are 7 days to expiration. So if we want to just see the price with only the days where there were 7 days to expiration, we change the formula parameter to 7. And so now the red line is just plotting when there were 7 days to expiration. And you can see that it's pretty much standard. There's really no more expectations, compared since the last earnings. You can see that price doesn't project any more expectations for a movement. So so that's an interesting thing to take a look at for sure. The gray line behind that is the price at every single expiration. It's the price at every single number of days to expiration. And you can, for every indicator here, you can actually change that parameter. So you take the 7 on the implied volatility. So that's the implied volatility on every day where there were 7 days to expiration. So that's quite a useful thing to take a look at as well. Right. The other thing that's interesting with EdgeRater is something that you've always been able to do with the program, is to go back to previous dates, run the program for a prior date. So I think we'll go and take a look at that. We'll go back to Straddle Busters. We'll choose a prior date. Let's go back to You can go to any of these. It's for May 15th. That's a good one. Let's run this for May 15th. So this is now going to show me a report that you would have seen if you had run the report on May 15th. And if you change your chart over to replay mode chart, and you select any of these stocks, now the chart is showing you what you would have seen on May 15th. So if you, I think it's always interesting when you see a certain chart pattern or your indicators are all lining up. It's always interesting to play the chart forward to see what actually happened, where you might have placed your buys, where you would have placed your stops, etc. And the EdgeRater has always allowed you to do that. So, so now we'll look at the top busted straddles on May 15th, and the most busted straddle, the straddle that was busted the most at 244% was Western Digital. Okay, so let's just do a little analysis of this. Like, what do you see as traders? What do you immediately see? You had earnings back on May the 8th. After earnings, the stock didn't really move. It traded down to this low down here, this 30-day low. And then it broke out through a 5-day high and a 10-day high on a very unexpected move up to 36.78. Okay, so having that information, you can decide, even if you're not trading options, you can decide that maybe you're trading this stock. Maybe this represents a good long trade. Okay, so you got to think about, is that a long trade? Where would you place your stops? Where would you place your entry point? But with EdgeRater, what you can do is play this forward and see what happened. So for me, let's just go back. Okay, so this was a breakthrough of these levels. For me, I would be looking at this red level up here. This is the 30-day high. This could offer some resistance, but before you get there, you've got some momentum and impetus and reason that you might actually make it up to here. And so as we play this forward, we can see now price is sort of slowly breaking out of those levels, and it actually came right up to that level. Okay, so that maybe that's it. Maybe that's where you take half your position off. Maybe you take the whole position off, and you could be done at that point. I'm going to play it forward a bit more. It does actually come back down, then breaks through this 30-day level. And as we see, we're just going forward here, price consolidating, just kind of inching higher as we go forward. Not very convincing. And then we have a sell-off here and even more. So this brings us up to present day. That's Friday. So yeah, potentially there was a trade that could have been made there up to the 30-day high. Let's take a look at another one. We'll go to Upstart. Okay, so with Upstart, what are we looking at? We've got the earnings date. You had a big up move on earnings, followed by a sell-off, and then you had this large green bar here. This is unexpected, 141% unexpected, took you above 30-day high, and then your 6-month high is up here at 26.35. Again, represents a good opportunity for a long side trade. You might have trouble figuring out where a stop should be because this bar is so long. Would you want to put a stop down here? That seems quite a long way away, $15 to $20. But you could put stops below here or anywhere in here as you see fit. But let's play this forward, see what happened. Okay, you broke through the new 30-day high, actually making it towards the 6-month high, and then breaks out through the 6-month high over here. That could be a trade done. Let's just play it forward again. So still making new highs, making new highs, making new highs. So it had a lot more to give at that point. And then we come down to, this is actually Friday's data. And as you can see, during this run up, there were a lot of unexpected moves. So something unexpected definitely was happening here. We were able to pick that up down here and, have trades where you can hopefully be sensible about where your entry is and where your stop is. There's another example. These are things that as you just come down through the chart, these are just going to pop out to you because you've got the lines on the chart here where the highs are. You've got the bars where the unexpected moves are. So really easy to see. That's kind of the beauty of the program. So here, what have you got? Micron, you've broken above 6-month high. You did that on a 100% straddle unexpected move. So going forward, how does that play out? Let's play that forward. So unfortunately, you've got no real target here because it's above the 6-month high. So where do you what's your potential target at this point? You have to go way back over here to look at other levels. You could have a level here at 74 potentially. Is there any resistance in between there and there? You're kind of at a resistance level here, but you potentially have moves up to 73, 74 level. So that might be something to put into a trading system. And let's see what happened. Okay, so it came right back up to here. And then sort of starts coming down again. And there we go. But actually it did make it up into this sort of level where this new resistance was. So again, that's a trade that could have been made, and you could have found that easily through this this template. Take a look at another one more, and then that'll be that. So JD, let's take a look at JD. Now JD is a bit of a different story because you've got earnings, a move up on earnings, move down, and then a move up, but didn't actually take out the earnings high. Okay, so you wouldn't necessarily want to trade that right away, but you might place stops, entry stops above this high. But so far, maybe that's not a long trade. Again, that sort of nudged it up a little bit. But then it comes down and it breaks down through the 6-month low. So, and then comes back up again to the high. So this is, this has come down. If you had done a long side trade here, you'd probably be out when it comes down here and then it comes back. So it's going to be a frustrating trade, or you probably wouldn't have taken this trade just because of the position of the stock. Anyway, I just wanted to show that. That's a really great feature of the program. You can go and choose any particular date, look at the stocks that were appearing on that date, and then play it forward to see what you might have done, and will accelerate your learning and experience of price movement without actually putting money into the into the market. Okay, we really have come a long way here, and okay, let us just bring up. I'll take questions in a minute, but I want to just say that. Come down through here. Demo, yeah. So the summary. Well, I'll take questions after this, but so the summary is whether you trade options or not, observing the straddle price will give you clues to expected movement in the underlying stock. Buying straddles gives you profit on outsized moves regardless of direction, and selling straddles allows you to profit on price containment. And the EdgeRater has some unique data, charts, and templates that give you insight that no other program has. So integrate that into your routine to gain a trading advantage. And thank you for attending. And encourage you to go to this web page here. This has an offer for anybody. Well, let's take a look at the offer. So if you are an EdgeRater user already, you'll know that you have to pay a fee to get the premium data. It's not that expensive. Let's be real. This data, it comes to you for $297 a year, basically. But the offer here, we will have to put this price up because of the amount of data that we're actually paying for at the moment. But this data is not, the price of this has not increased over 10 years. And so the offer today is, if you have EdgeRater and you have let your subscription to the data lapse, so you want to try this new thing, you can now get 14 months of this data for the original price of 12 for only $297. Click on that link, you'll come to this, add it to your cart, check out, you'll get 14 months of data. If you don't have EdgeRater, you can have the lifetime license to the software for $1,000 instead of $2,000. Great. That's the best deal that we've ever had. And that will include a year's worth of the premium data, so you don't have to worry about that. After a year, premium data will kick in, currently $297. So if you wanted to get an extra year of premium data, you could also buy that. It would be added onto your license, and you would then get 2 years and 2 months of data. And then, of course, we have the amazing ETF Trading Bandit, which you do not require premium data for that, but for $250, you get access to signals, basically for a lifetime, using free data sources, and that is a great program that's done really well. So anyway, those are the offers we have. I also want to mention next weekend there will be a follow-up webinar about core templates in EdgeRater. So we won't go into, I believe this will actually be a core template, the straddle busting template, but there are core templates that we like to use a lot. And next weekend, I will be going through some of those. So please sign up for that webinar, be at the same time next week. And thank you for that. And I will take a look for questions. Okay, where's the link to this? This is, if you go to, if you have the slides, I did send out a link to the slides. The link will be in there. Otherwise, just go to edgerater.com/webinars/SB June 23. I don't know if you can see that on here. Okay. I think Dave, yeah, that's great. And we'll look at that next week. So Dave McMullen was just asking about weekly squeeze. Yeah, so next week when I go through some of the core templates, we'll take a look at the weekly squeeze as well in combination. You're welcome. And you can extend your premium data with the offer. Yes, Ross, you can. Absolutely. You buy that offer, you will just get an extra 40 months added to your current subscription. So Paul, sorry, let's have a look here. So Ross, yes, Straddle is related to expected move. And busted means loses money. Depends if you are a buyer or seller. But yes, if the straddle is busted, it just means that the break-even points have been broken. Normally, retail traders are the people on the long side of the straddles. And so the retail traders will make money on a busted straddle. But in general, the thing to really be aware of is that busted straddles means that expectations have been broken. Okay, that's important. Something's happening, something that you can see in options that you can't see with any other technical indicator has happened. Okay, price could move a lot. You know, price could move 5%, and a straddle will not be busted. It's possible for that to happen. It happens all the time. All right. A normal technical indicator would point that out to you that the 5% move has happened. It's broken through this, that, and the other. And you might be concerned, but if the straddle is not busted, it means that that was actually an expected move. So that's how the options give you, information into the future volatility that's expected in the stock. Shashi, this is the start. This information is the start of EdgeRater options data in the program. So there are lots of other strategies people use, and we're going to be adding more data and more templates as time goes on. You're talking about selling puts. That's something we can look at to create some information around put selling, for sure. We'll also have information around strategies such as credit spreads, debit spreads, all kinds of other things. Okay, Jeffrey, that's a great question. Yeah, so if there are several busted strategies in a row, then do the option prices factor in the higher volatility, then called busted to be followed by periods of non-busted? That is a great question, and yes, I believe that is true. And let's go back to take a look at something like space. I think this is a good, is this a good example? I did see a good example of this actually earlier today. Okay, so yeah, so space, Virgin Galactic Holdings. Okay, there's been a lot of busted straddles and busted by a lot recently. Now on Friday, the implied volatility of the next expiration has really gone quite high, 1.97. The price as a percent of the underlying has also gone really high. So yeah, in this case, the straddles have been busted, expectations have been broken, and now in order to buy that straddle, you're having to pay a lot more than you did before. So yeah, it's true. As more straddles get busted, price goes up, and the less likely that those straddles are going to be busted in the future. But as you can see in space, that happened interestingly on the way up. Yeah, with a 150% gain in the straddle on this, the 16th of June. And then on the way down, just recently, this Friday, on the 23rd of June, you had also 150% gain in the straddle. And that's kind of the beauty of the straddle, is it's really directionless. You don't care if the price goes up or down. You just need it to move. If you own a straddle, you need it to move a lot, or a lot more than expectations. Okay. Yeah, thanks everyone for coming. I will put this recording online, and I will send an email out to everybody, so where you can find it. And if you have any questions on this template, you can always email me. Come along to the presentation next weekend. Sign up online for next weekend's presentation. And if you have any questions about today, you can ask them at the presentation next weekend too. So, so that's that. All right. Bye-bye.